And then, of course, there's the stimulus that was passed in February. This is our estimation of what the federal stimulus has added to GDP growth. And there's two main points that I want you to realize here. One is that we have probably already seen the peak effectiveness of the stimulus. If you look at this graph, you can see 09 Q3, and that's when I mentioned when GDP growth turned positive. The stimulus added about 3.5 percentage points to GDP growth. So if you take that away, GDP growth probably would have been slightly negative. But what you can see is that as we go into the current quarter, as we go into early next year, the impact of this positive impact of the stimulus is going to fade. Now, a lot of you may say, well, but I've read these stories and only, 30% of the stimulus money has actually been doled out yet. Isn't there a lot more to come? Yes, there's a lot more to come, but the stuff that has already gone out is the most effective in terms of boosting both consumption and business investment. So if you look at what's already been done, it's mainly been aid to state and local governments, direct aid to state and local governments from the feds. And then you have things like extended unemployment insurance benefits, extended food stamp benefits. We all got a little payroll tax cut earlier this year. These types of things, and economists attempt to measure these things by using a multiplier effect. So saying, okay, if we increase unemployment insurance benefits by this amount, how is that going to ripple through the economy? These types of stimulus, the stuff that's direct aid, usually to the people that most need it, so the people that are out of work or lower income people, that stuff usually gets all spent. When you give aid to people in higher income brackets, they tend to save more of it and not spend a lot of it. So the stimulus that's already been put out there is probably the biggest bang for the buck in terms of all the stimulus that there is. Most of the remaining stimulus that hasn't gone out yet is a lot of the infrastructure spending projects, so they're public works projects, or it's money to state and local governments to repair roads and bridges and that sort of thing. Those are going to add jobs. They're going to add a lot of construction jobs. They may add some federal government jobs or some state and local government jobs. But for the most part, in terms of real economic growth, in terms of how it's benefiting consumers, retailers, the biggest impact by far was in the third quarter. If you look further out, if you go out into 2010, you're going to see that once that stimulus starts to fade and it's not there anymore, it's going to become a drag. And what I mean by that is that you have all this money in one quarter, you take it away in the following quarter, it disappears. You're coming down from a big boost. It's sort of a shock to the system. So that once all of that stimulus money has flown through the economy, it's actually going to become a drag on GDP growth because it won't be there to prop up growth anymore. Some economists debate what this may mean for the recovery. Some people think that this actually may interrupt the recovery and that there's a risk that we fall back into a recession. You might have heard of the recovery described in terms of letters. Anyone heard this? Like a V-shaped recovery or a W-shaped recovery or an L-shaped recovery. That sort of, what that is it's describing, take a V-shaped recovery, which is usually what we see after a really big economic downturn. What that means is you have a huge downdraft in growth. And usually, the worse the recession, the more quickly and the more strongly it bounces back because you just have this huge pullback in demand that when economic conditions recover, there's so much pent-up demand that people go out and they buy cars and they buy houses and they buy stuff, and it's a huge hit to the economy. So there's one school of thought that thinks we're going to get that. I think there's fewer of those economists left. More people are thinking this is going to be a jobless recovery. We think it's going to look more like a U-shaped recovery where we may be out of the recession right now, but we think 2010 is going to be really weak. So you're not going to have this huge bounce back right away. Stronger growth is probably going to be in 2011, 2012, once a lot of the housing market problems are worked through, once the stimulus has worked through the system and there's a chance that the economy starts to get into sort of a self-sustaining expansion. So this is going to we're going to bounce along the bottom probably for much of next year. Other good things that are happening, I think in many ways this sort of, you might say, psychologically scarred a lot of people after this downturn. we're seeing the savings rate is at a cyclical high for sure. We're seeing savings rates around 6–7% right now nationally, which is unheard of. We had negative saving going into this recession when people were just leveraged up to the hilt, either because they took out home equity loans or home equity lines of credit, or they had credit cards maxed out. We know that a lot of the early stimulus, and even some of the stimulus, if you remember back to the Bush administration when they mailed out checks to people, a lot of that went to savings or paying down debt. And so now what we're seeing is the savings rate has popped back up. And the interesting thing that we're seeing is that it's among all income groups. So if you look at this slide, these percentages, these different parts of the bar represent income distributions. Typically, you see the top maybe 15–20% of the income distribution. These are your savers because they have the money to save. They don't need to spend all of their disposable income. So those are typically the people that save. People at the lower end of the income distribution tend to spend most of their money because simply they have to. But what we're actually seeing now is that almost across the board among all income distributions, people are saving. And again, a lot of this is simply paying down a lot of the debt that they had racked up before. Another part of it could also be that, we know that there's, in many parts of the country, we have still a mounting housing foreclosure crisis. Once those people lose their homes, then the mortgage debt is not on them anymore. It's either transferred back to the bank or the new buyer of the home. But either way, we're seeing savings rise, and we think that this could be an interesting phenomenon for long-term growth, because if savings rates are persistently high, that could mean a little bit slower consumption growth in the overall economy, and we do think that'll take a couple of notches out of long-term GDP growth. So if people are saving and they're not spending, you're just going to see a little bit of growth shaved off of long-term GDP growth. Now, okay, here's the bad stuff. So technically we're out of a recession. People are saving, people are fixing their finances. We are starting to see some recovery in the housing markets nationwide, especially some of the ones that were most problematic, like in California and Florida.